Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed 1 million reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also track regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you will want to hear this. Many investors here chase yield without spotting the trap. We love steady coupons, strong brands, and big names. But Hyflux showed us that hybrids and weak disclosure can turn so-called safe income into permanent loss. I've boiled this complex story into 7 crucial points that will change how you assess risk in Singapore's income market. These ideas will help protect your CPF and SRS, make your portfolio more durable, and keep you ahead of the next blow-up. Here's what we'll cover today. 1. Business model risk beats brand. 2. Capital stack ranking rules recoveries. 3. Read SGX disclosures like a detective. 4. Hybrid securities complexity made simple. 5. Bank behavior as an early warning system. 6. Portfolio actions for CPF and SRS investors. 7. Using the Hyflux trial timeline as a live classroom. Let's dive in. First, business model risk beats brand. Hyflux was a household name. Spring was not just a water project. The profit engine relied on selling electricity to the grid. That is a very different risk, linked to power prices and market volatility. When a company shifts into a new business line to make the project work, your risk climbs. Think of a hawker famous for chicken rice trying to serve sushi the next day. The branding may be strong, but the operations, margins, and safety checks are different. The lesson is clear. If profits hinge on a new business line, demand a quantified revenue split and sensitivity to the risky inputs. If the company can't provide that, treat the security as high risk. For CPFIS funds and SRS portfolios, screen for clear segment disclosure and low reliance on volatile markets like merchant power or commodities. Ask yourself, if I cannot forecast the new profit engine, why accept a low coupon for it? Second, capital stack ranking rules recoveries. In distress, ranking matters more than coupon. Preference shares and perpetuals sit behind senior bank debt. That is why junior paper can go to 0 even when the brand is well known. A 6% coupon won't save you if you are last in line. Think of it like HDBQ priority. In a crunch, some buyers get keys first. In capital markets, senior secured lenders are first, then unsecured lenders, then hybrids, then equity. Before buying any hybrid, find out exactly where it sits in the capital stack. If it is junior to bank debt, assume 0 recovery is possible and price that tail risk. If your returns rely on redemption at the first call date, run a no-call scenario. If the math fails without a call, pause. Third, read SGX disclosures like a detective. Continuous disclosure is meant to prevent false markets, where investors trade without key information. Your role is to spot what's missing. Is there a clear revenue breakdown for new ventures? How sensitive are profits to volatile inputs like power prices? Are banks steady or pulling back? Do announcements use vague words like synergy or diversification without numbers? The practical step here is simple. Before buying, scan past announcements around major projects. If you can't model revenue because the numbers are missing, move on. In Singapore, most income names release frequent updates. Use them. Build a 1-page fact sheet for each holding. Note segment mix, leverage, the debt maturity wall, and key banking facilities. Fourth, hybrid securities complexity made simple. Hybrids look straightforward. You see a fixed coupon, a perpetual structure, and a call at 5 or 7 years. But the risk hides in the details. Reset formulas matter because the coupon after the first call can change the economics. Step-ups are designed to push the issuer to redeem. In distress, the issuer may choose not to redeem and still cannot handle a higher coupon. Coupon deferral features also matter. Some hybrids allow discretionary deferrals or have non-cumulative coupons. Here's an easy analogy. Hybrids are like a fancy copy with many add-ons. It tastes great when fresh, but if the machine breaks, meaning cash flows fall, the barista cannot serve, and you still pay rent. Assume bonds are not called at the first date. Would you still own them? If the issuer's free cash flow and leverage trend cannot carry a higher reset coupon, the risk is higher than it looks. Fifth, bank behavior is your early warning system. Banks see the deepest data. When they reduce commitments, add tighter covenants, or shorten loan tenors, they are telling you something. For big projects, syndicate withdrawals are a bright red flag. Add a bank pulse line to your due diligence. If lending dries up or refinancings keep getting smaller and shorter, reduce exposure. In Singapore, look at how often an issuer taps capital markets versus extending bank lines. Shorter, smaller, and tighter deals point to rising risk. Ask yourself, if banks are stepping back, why am I stepping in? Quick reminder before we continue. For detailed charts, deeper dives into the data, and a full written breakdown of today's topic, check our Substack. The link is in the description. Sixth, portfolio actions for CPF, SRS, and yield hunters. For CPF, keep the core high quality. Prioritize investment-grade exposure, and where eligible, senior bank capital or short duration. Avoid unrated or opaque hybrids in CPF-linked allocations. For SRS, build a ladder. Use SGD credit and Asian investment-grade funds as the core, then a small hybrid sleeve with strict rules. Cap single-issuer exposure at 2 to 3%, so no one name can hurt you. On the REITs versus hybrids debate, remember that many large-cap REITs disclose property-level net operating income, debt maturity profiles, and interest cover more clearly than many hybrid issuers disclose their cash flows. If you are chasing an extra 1 to 1.5% yield by moving into a hybrid with fuzzy disclosure, ask if that premium is worth the added risk. Use a simple pre-buy checklist. 1. Is there a new business line, and do I have numbers? 2. Are profits exposed to volatile inputs, and have I run a downside? 3. Where does my instrument rank, and can I accept zero recovery? 4. What is the bank pulse, and are they pulling back? 5. Assume a no call. Can the issuer afford the reset coupon? 7th, use the Hyflux trial timeline as a live classroom. The criminal trial started on 11 August 2025 and is scheduled across dozens of hearing days into early 2026. You can expect testimony from former management, lenders, and market regulators, plus documents about how announcements were drafted. Treat each session as a new filter for your due diligence. Build a one-pager for every lesson and apply it to your current holdings. If a holding fails 2 or 3 filters, scale down. This way, you learn in real time, and your portfolio improves with each update. Here's my personal take. This is the most important risk lesson for Singapore income investors in the last decade. Yield is not free. When a company steps outside its lane, you need numbers, not slogans. My direct advice is simple. Run the no-call test on every hybrid you consider. If the cash flows do not support the reset coupon, skip it. Put bank behavior at the top of your watch list. If banks blink, you move first. For CPF and SRS, let quality lead. Use a small satellite sleeve for higher yield, but rotate fast when disclosure thins or leverage increases. After years of studying local blow-ups, the pattern repeats. New business risk, vague disclosure, higher leverage, and late reactions. Do not be late. Build your rules now. The boring rules save money. Let's wrap up. We covered 7 points. 1. Business model risk beats brand. 2. Capital ranking decides outcomes. 3. Read SGX disclosures like a detective. 4. Hybrids hide complexity behind simple coupons. 5. Banks send early warnings. 6. Concrete portfolio moves for CPF and SRS. 7. Use the trial as an ongoing lesson. If you internalize these, your income portfolio becomes sturdier, calmer, and more compounding friendly. If you found this helpful and want to level up your investing game, please like the video, share it, and subscribe to the Investing Iguana so you don't miss our next insights. And for those who want to be truly ahead, our premium members get exclusive early access to all our videos, often a full week before anyone else. You get my detailed analyses and urgent insights on market moves delivered to your inbox, giving you a head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your steady daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Click the link in the description to become a premium member today.